Good morning, everyone. Thanks for joining me this morning. So, today we're going to tackle the all important topic of saving for your child or someone else in your family for their college expenses. Those higher education expenses can be pretty phenomenal. And obviously, starting sooner than later is very beneficial. But I'm going to focus today on five things that you should think about and try to avoid to the best of your ability. First of all, procrastination. Um, so you might say, well, my child's in high school now. It's too late for me to start. It's never too late. So trying to put a game plan to in place is a phenomenal way to help them through this process. But where do you start? So I'm going to actually talk about researching different types of companies, or different types of investment vehicles. So that's the actual second choice, because there's a couple of different choices to pick from. And the first one, which most of us have heard about, are these 529 plans. And some people might say, well, are they really worth it? So how they work is each state is a sponsor of a 529 plan. All the 50 states actually have their own plans. Some states have more than one plan. Since I'm in Pennsylvania, I'm going to just mention, so Pennsylvania actually has two types of plans. One is market-based, and the other one is actually paying for tuition in today's dollars, buying credits today that will not um, or that will just accumulate in value. So, for example, if your child is age 2 and you're part of this in Pennsylvania, it's called the Guaranteed Savings Plan, and you buy 5 credits while they're age 2, those 5 credits are going to be worth the same cost that they would be when they're age 18. So your 5 credits just travel with you. The other ones that are market based can be determined, the underlying investments can be determined based upon their age. So when they're younger, it's going to be a more aggressive strategy. And when they get closer to needing it at age 18 or 19, they get more conservative. You can pick your own investment choices within the plan. The one thing you have to deal with on a day-to-day basis is the volatility of the market. Obviously, with a child when they're younger, you can deal with much more volatility, but when you're dealing with someone who's in high school and needs that money in a very short time frame, maybe you need to have something more conservative or something that's not as market driven. With this Pennsylvania Guaranteed Plan, actually, it increases each year based on the average cost of college increases. And I'm not going to spend a whole lot of time on it here because it's actually a little complicated, but it is the product that I use for both of my kids, and started when they were relatively young. And I had family members that would come to me and say, well, I want to help. How could I contribute? And so they would just make their checks payable to the plan. The other advantage is many plans actually give you a state income credit or deduction for actually putting money into their state's 529 plan. So doing some research on that would be fantastic. The money grows tax deferred. When you take it out to pay for qualified education expenses, it is not taxed at that point either. So it's really a home run. So a second choice in regard to account types are what are called Coverdell ESAs. ESA stands for Educational Savings Accounts. And these accounts actually are kind of set up as a trust or a custodial account, and you are limited. You're not allowed to put more than $2,000 a year into the Coverdale. And you actually have to meet the modified adjusted gross income limitations. So with a married filing jointly couple, it's $190,000 for the year. And if you're filing under a different level, whether it's single or widowed or whatever it might be, the modified adjusted gross income level is at 110,000. Now, just like the 529 plans, you put the money in, it grows tax deferred, you take it out and use it for qualified education expenses, and you don't pay any taxes on the withdrawals either. The one trick with the Coverdales versus the 529s is that when the beneficiary or the individual that you're saving for reaches the age of 30, you are required by law to shut down the account, pull the money out. There might be taxes, there might be penalties and things that have to be faced at that point. So if the money's not used for education expenses. Now, with the Coverdale, you can also use it to cover up to $10,000 a year for K through 12, through 12th grade. So you can use those for those expenses as well. Actually, the 529 plans are giving those options now as another alternative. Let me make sure I haven't missed anything. The other thing about setting up the Coverdales is the beneficiary that you are setting it up for must be under the age of 18 when the account is set up. Doesn't mean you can't fund it after they're 18, but you need to set it up prior to the age of 18. Now, a third option as far as savings would be a Roth IRA. And actually, I took advantage of this. Both of my boys worked for my firm when they started at age 14. And what I did was I set up a Roth for each one of them. And then based on the amount of money that they earned in those particular years, I matched and I made the Roth contribution. At age 14, what the rules that go with a Roth is that you have to keep it in there for a minimum of 5 years and, before you can withdraw it for purposes of avoiding taxation. And my thoughts were they would be age 19 if they wanted to use the Roth for purposes of covering their education expenses. It was there and they could do it. I'm proud to say that my son said to me when we were looking at his options to help pay for his education, he said, "Well, I'm not touching that Roth. It's for my retirement." So he chose to go a different route, and in his case, he actually took out a loan, which we'll get to in just a second, versus touching the Roth because he knew the value of compounding money there. So Roths can be used to cover education expenses. The next two items or two types of accounts I'm going to mention, I'm going to talk about them hand in hand, are Uniform Transfers to Minors Act accounts and Uniform Gifts to Minors accounts. So for those that are of my generation and maybe older, these are the types of accounts that many times our parents set up for us. And so when we were minors, they set up these UTMAs or UGMAs. They were the custodian, or yeah, the custodian of the account, and we were the beneficiaries. But once money went into these types of accounts, they became ours as the beneficiary, even though they were under the age of 18 and you really couldn't get to it. At the age of 18, those accounts had to be retitled into the beneficiary's name. Now, I use age 18 because most states, that is the age of majority. If you're in a state where the age of majority is 21, that's when it needs to be converted. So what's the difference between the two? A UTMA, a Uniform Transfers to Minors Act account, are primarily for what they call financial investments. So it can be a savings account, it can be a CD, it can be savings bonds, it can be an investment account. But things that are publicly traded go through a bank type of a situation. Whereas a UGMA, a Uniform Gift to Minors Act account, can actually incorporate real assets. And what I mean by that is it can incorporate property like real estate. It can do commodities like precious metals. You could purchase gold within a UGMA. So that's the primary difference between the two of them. And the last investment vehicle is a trust. So you can create a minor's trust in which you save money inside of, and then obviously is used for education purposes. They can be a little bit more confusing from the standpoint of you do have to have an attorney draft the document. You have to make sure that you follow the rules and regulations that you've set up within the trust. And trusts tend to be in a higher tax bracket. So I actually have had clients who've had set up minors trust, but it has probably been close to 30 years since we've been using that type of a vehicle because we've got some other choices here that can be less expensive and can be as beneficial, especially from the standpoint of the assets growing tax deferred and coming out tax free. So the third mistake that I want to talk about is buying investments with annual fees that are associated with them, and the fees tend to be on the higher side. So you might say, well, what exactly is that? Well, I'm going to step back to the 529 plans. You want to be careful with those, especially if they're being recommended by an advisor where the advisor may be making a commission off of it. Pay attention to that. Also, pay attention to the underlying investments that go along with it to make sure that there isn't a high expense ratio that goes along with it, or you have to pay an annual fee because there's plenty of 529 plans out there that don't have an annual fee associated with it. Or if they do, they come up with some alternative. For example, if you set up some type of automatic savings, like if you're putting $25 a month into it, they're going to waive the fee for you. The other types of vehicles that might have high annual fees associated with them might be insurance products. So if you're looking at purchasing I've heard of people suggesting using a whole life policy and building up the cash value within the policy and then using that cash value for education expenses. That can be expensive. You've got potentially a commission that's being paid up front, and then you've got the annual expense ratios that go along with the product. So whole life insurance, annuities can be another vehicle that could be recommended. So pay attention to what you're paying for when you go down that road. So the fourth mistake is relying on your own retirement to pay for those college expenses. So just think about it. If you have been saving on your own, maybe now you're in your late 40s, in your 50s, and now you're going to turn around and take money out of your retirement savings to pay for your child's college education. So essentially, you're going to be starting at day one again for your retirement. So be very careful about taking any money out of your own retirement. Don't sabotage your longer term plans to help pay for college. And so when I talked about looking at it starting sooner than later, that's why all these other vehicles I was just mentioning might be great alternatives versus you having to worry about your own retirement. And the last mistake is to worry about taking out loans. Um, it's not a failure that you have to take out a loan to pay for college. There obviously are some other alternatives that you can take a look at. You might want to strategize and have a child evaluate where they want to go to school and how much money is being set aside and how they might get the most bang for their buck. But if it comes down to it and there is some particular school they want to go to, some particular program that they want to be associated with, then by all means, take a look at the options as far as loans go. Now, some of the federal loans out there have some phenomenal interest rates associated with them. I've got some clients right now who have 0% finance or 0% interest rate on their student loans. Yeah, they're paying them out over an extended period of time, but that opportunity is there, and it's much easier to deal with than if you've got a higher interest rate loan. Maybe you've had to take out a personal loan, and maybe they're 10%, in that range. Um, Also, getting to understand what's the difference between a subsidized and an unsubsidized loan, the payback methods that go along with that. And then to also understand their opportunities that the child may have, depending upon what area of study they're going into, that job that they take may qualify for opportunities for their loan to be forgiven in some fashion after a certain time frame. Um, the other thing I'm going to suggest too is to also fill out a FAFSA form. They've actually made them much easier. I believe it went into effect this January, the new condensed form and how to fill that out. It's a lot easier than it used to be. But there's also opportunities that come along with those. There might be financial aid. There might be the opportunity for your child to do a work study, but they encourage you to fill out this form in order for them to qualify to get those types of opportunities. So you may think that you're in a high tax bracket, that you're making too much money, but I always encourage doing the FAFSA form regardless. So those are the 5 tips I have as far as, mistakes not to make. But as always, your situation may be different than your neighbor's situation. And I encourage you to talk to someone like myself, a financial advisor who can really understand your situation and give you good advice as far as how to come up with a plan that makes sense for you. So if you have any questions, give me a call at 412-346-4655. Send me an email at diane@pearsonfinancialplanning.com or a direct message right here through Facebook. As always, I appreciate you joining me today. And if you found this information of value and would like to share it and have other women join our group, please let me know. I'll be happy to send them an invitation. And have a great day.